Oh man, it happened again, y'all. We had inflation come in at a new high. Inflation increased 0.4% in September, more than expected despite these rate hikes. So if you're wondering, the core CPI came in at 8.2 versus 8.1 expected, and it's not as high as it was in June, which is around 9%. You can see right here, food and energy, core consumer, when you exclude food and energy, accelerated 0.6 and 6.6% respectively. The yearly gain for core was the highest since August of 1982. Oh man, our core inflation is the highest it's been in 40 years, guys. 40 years. I ain't 40 years old, so I've never seen anything like this in my lifetime. And you can probably say the same thing about wages here too. Wages took another hit, falling 1.1% monthly and 3% year over year when adjusted for inflation. Let's check out this video. The consumer price index increased 4%. Who's gonna play it?
Let's start out with CPI for the month of September, up 0.4 on headline, double the expectations, and that is the highest since, June, when it was at its peak at 1.3. That was the highest since 2005. If you strip out the all-important food and energy, also 0.2 hotter, up 0.6. That's the hottest since June, when it was up 0.7, high water mark all the way back in April of 21, and up.
Still, since June, it hasn't even budged. It was at 0.6% in June. Dude, that's energy. We're talking about energy now, man. I remember when gas prices in June were like $5. Oh man, they were up high. They were in my area. They were getting up there to almost $5 a gallon, man. I live down here in the South, as you can probably tell by my accent. I think right now they finally got back down to like $3.50. Man, we'll just have to wait and see how it goes, won't we?
Up 0.9. Year over year numbers, 8.2. Hotter than expected, but cooler than the rear view mirror, 8.2. Until we get a revision, it follows 8.3. The high watermark here was 9.1. That was in June, going back 4 decades. And finally, year over year, strip out food and energy, also hotter than expectations, up 6.6. That follows 6.3, and 6.6 is a new high. The old high was 6.5 in March. That went back to 1982, but in 1982 we went all the way up to 9.3. So even though it's a new high watermark,
9.3. That's our old high. We never did get quite that high, but man, we're close to it. So it's pretty bad. It's pretty bad times for inflation, man. All that stimulus during let's call it a thing. All that stimulus we had these past 2 years, man, is coming back to haunt us. You can't just pump the economy and just print trillions and trillions of dollars out of nowhere and not expect something like this to happen.
It doesn't change the comp back 4 decades to 1982. If you look at yields, they are just skyrocketing.
Look at gold.
Back up to 4% in tens. Now let's go to initial jobless claims. 220.
And that's interesting too, because usually gold tends to fare well in a recession. So it's weird to see gold start to crash along with the market. That's how you know that the whole market is just scared. A lot of this is just a big fear overreaction. I wouldn't be surprised to actually see some green in a few days.
28,000. That is up 9,000 until we get a revision to the 219,000. And on continuing claims, 1,368,000, darn close to expectation.
Bitcoin was at 18,000. I just caught that. Bitcoin. Crypto, man. It's just been a rough year for crypto. Ever since Bitcoin fell off its highs of 68,000, man, it just can't find a bottom. You just can't get it. It just can't go, man. It's go down. It didn't even take the stairs down to it. It took the whole escalator, man. It went from the damn penthouse all the way down to the ground floor, man. Rough.
Very close. Also, the rear view mirror of 1,361,000.
You can see everything else down today too.
See the yields have shot up here to 4%. And if you look at what's going on with regard to 2-year note yields, they're all the way back up to 4.32. So this is a hot number, and with the expansion on that 6.6 on the core, and we all know it's about food and energy, this is definitely going to pique the ears of our central bankers domestically and globally. It's going to make the dollar index much hotter, and it may also complicate some derivatives that you were talking about earlier. I used to run a derivatives products group. There's two things you can't control: what we call discontinuous volatility. When gilt prices and yields get crazy, you can't make your periodic adjustments that you need to make, and option volatility.
We're going to 10-year Treasury just skyrocketed up 4%. That's one thing. The Treasuries and the I bonds, man, they're good, safe investments right now to make money in. Good place to park cash if you're scared and want to just hang on. Me, I'm gonna keep buying stocks though. Anytime stocks just have a really bad fear day like this, I'm just gonna be a buyer. You don't get too many big scary red days like this, and you never know when they're gonna come again once this year is over and once we get back into the normal market the way it normally behaves, man. You got to be a buyer in these situations.
There's no way to compensate for gap jumps and option volatility. If your models are replicating your pattern of payout based on options, volatility moves up or down in a dramatic way. There's very little you can do about it, but take a hit. Becky,
dollar higher.
Take a hit. That's
something I was saying in my video yesterday, is that the dollar is just going ballistic, man. The dollar has just been on a steady increase just ever since we first started all of this recession talk, and ever since inflation started getting way out of control. Other countries, they let their inflation get out of control too, but they're not really in control of their fiat because their currencies aren't world reserve currencies like the U.S. dollar. So when they pull out of a trade, they don't really have nothing to fall back on. You know, we can cut off business with one part of the world, and we're still doing trade with the rest of the world. You know, we're going to hold up fine, but like Britain and Japan and all these other countries around the world, they can't say the same. I know their economies were all they had all fell down ahead of time waiting for the CPI data. So it's rough out here.
That's what we are seeing in the markets right now. Rick, stay with us, but let's run through these boards. Right after this number that was hotter than anticipated, you're talking about up 0.4% month over month on a month-over-month core. Ex-food and energy, you're talking about CPI up 0.6%. That's 0.2% hotter than expected. We immediately saw a massive shift in the futures markets. The Dow futures now down by 300 points. We've been up by about 300 points before, maybe up 250. NASDAQ is indicated off by 276, and the S&P down by 58 points. If you've been watching yields, this is a real story too. The 10-year, I saw push above 4% on this. Sitting right now at 3.97.
And take note that the 2 and 5 year are actually higher. They're about 4.5% versus these are about 4%. So you'll see that a lot in times heading into a recession, is that the 2 years and the 5 years will get out in front of the 10 and 30 years. The short-term Treasury notes are paying better than longer Treasury notes. It's usually a sign that your economy is not doing too well. What do you guys think? Do you guys think the economy is doing well right now?
7%, the 2 years, 4.43%.
That's insane,
very
man.
Significant moves, completely reversing what we'd heard on this expectation, these kind of rumors that are out there that Liz Truss's government might reverse. That calmed down yields earlier across the globe, but this is a whole new thing. Because this is an expectation of what's going to be happening with the Fed not able to take the foot off the gas at this point, continuing those rate hikes. Let's bring in our panel at this point to talk more about it. Betsy Stevenson is a University of Michigan professor of economics and public policy. Nancy Davis is the founder and chief investment officer at Quadratic Capital Management. Neela Richardson's here from ADP, where she's the chief economist. We've got Steve Leisman and Rick with us too. And Steve, just take us through these numbers, the things that really jumped out. What caused this higher inflation?
It's where exactly I told you it was coming from at 8 o'clock, which was the service sector. You had a big rise in rents, but even you take the rents out, everybody says that's a lagging indicator. There is just nothing in here to tell you that there's reason for the Fed to pivot. And I can tell you right now, the one number here that is maybe the most significant, I've not seen this number before. Rick will either back me up or shoot me down. 483 on the peak funds rate April 2023. I'm just making sure that's the high water mark.
So
yes,
it
is. April 2023, we were at 468 going into this 469. We've not seen the new funds right now, 483. And again, nothing in here. Everything the Fed, look, they have been medium term to long term wrong.
Yeah.
Short term, they've been right when they've been coming forward. And you had Mester, who took a little heat the other day, saying you can't even say inflation has peaked yet. Well, you can't even say inflation has peaked yet, at least in these numbers. We can argue about whether or not the Fed's watching the right numbers or not, but you look at the panoply of service sector numbers in here, and you see them rising. There has been a little bit of relief on the good side where the commodities less
Is
energy.
there any sign that with the Fed?
That's crazy, y'all. That's crazy. Housing is like the one thing that hasn't failed yet. Shut up.
Workday has helped
Shut up,
make a
dude.
complicated ecosystem more.
Hush. I don't really want to hear you talk right now. But yeah, housing, there's really two things we got holding this market up right now, and that's housing and labor. So if you've seen the recent report back in September, we saw that there was 263,000 jobs, jobless. What was it? 263,000 new jobs in September, something like that. And we had the lowest unemployment rate of 3.5%. I think that's the lowest we've ever had. So the labor market is crazy strong right now. But if you remember, if you were around long enough to see this, it was like that during 2007 too, right before the recession. So we'll see how that goes. Usually labor gets pretty good right before a recession because usually record low unemployment follows record high unemployment. And then the other thing holding up the market is the housing market. The prices on houses have just gone astronomical, dude. They're just nowhere to be found. If you ever even seen how rents are right now, or if you rent or you have a mortgage, you already know because mortgages are at like a 6, almost 7% interest rate right now. Man, not for me, man. I'm glad I own my own home, man, because man, that's rough. What do you even do, man? This inflation is just eating everybody away, man. But just bear with it, y'all. It's gonna be tough. It's gonna be a tough few months, but stay invested the best you can. Hunker down and save money. Don't try not to spend all your money if you can help it, because this is a fantastic time to buy stocks, man. I mean, you want to pull up the charts right here and take a look. You're not going to find too many. There's so many discounts in the market right now. Google's at $95, man. Google, Google, Apple, Apple. Where's Apple at? The biggest stock in the world. Where's she at? 135. Oh man, not 52-week lows down here at 129, but we're getting pretty close. Man, I might have to pick up some more Apple here later. That's just man. Let's tell you, people like Tesla. I like Tesla. Let's look at Tesla, and I'll go and end the video on Tesla. Tesla. Ooh, $200. Can we break 200 on Tesla, y'all? Let me know if y'all think Tesla will break below 200, because we got it down to 206 at one point. Can we get it back down there? Can we get Tesla for below $200 again? Man, that'd be crazy, wouldn't it? Be fair, this would be $600, $25 or so pre-split. Man, back when it got up there to 1,200. Man, it's got 2x potential just to all-time highs right now. That makes it a good buy for me. But I'll wait and see if there's any more bleeding today before I start to hop onto anything. But yeah, guys, the market's just gonna have to be down for a while. But it's just gonna have to be okay. And like I said, just stay invested, stay the course. Don't let all this negativity get you down either. The market will be okay. The one thing I will promise you is the market will be okay. But this has been Tiggers and Tokens, and I'll catch you guys in the next video. Please like and subscribe if you enjoyed the video, and I'll see you in the next one. Take care.